my first live. We have a few people on here. It looks like 5 so far. People keep clicking in. And Michael helped me get this sound working right. But I want to thank everybody for coming on. And I want to just cover a few of the things that this channel is going to talk about. So this is my brother-in-law, Pat. Pat right here beside me. And we've had some pretty good luck, doing some walk and talks and discussing stocks and options. And Pat is new to it. He hasn't ever traded before through an online broker. And he plans to do it a lot here in the near future. So a lot of his questions are very good. And I like to have people that are brand new that can actually, ask questions, and we can answer it. So the channel is going to be about how to trade options, and a lot of it is about how to work the risk management and how to work the extrinsic value of trades. Now that might be Greek to everybody, and including Pat. That might be Greek to everybody, but my channel is going to be a lot different than what you see out there on YouTube. Most of the YouTubers are trying to show you how to pick which stocks, and we'll talk a little bit about stocks and what kind of research I do to decide which stocks work or don't work for me. But I'll kind of explain what trading options involves, and why you buy stocks so that you can trade options. There's ways to trade stocks and put options on them, and there's ways to do synthetic stocks, where you actually don't buy the stock, but you buy options and you sell options, which act the same way as actually owning the stock. We can talk about Philippines and we can talk about stock. And that's what the channel is going to be about. But the first thing I guess I would start off with is understanding why we do what we do here with Trading with Rich. This is not a stock picking channel. This is not a get rich quick channel. This is about taking assets that you already have, or just money that you have, and writing options on them. Now, giving you the ability to write a weekly paycheck and put that money into your checking account. And a lot of people think of this as day trading. A lot of them think of it as swing trading. We'll just hold the stock for maybe a week. No, this is actually, let's hold the stock, or at least have an interest in this stock for the next 3 to 5 years. And it's not about holding the stock for 3 to 5 years and then seeing if we can, make a profit off that. That's part of it. But the real reasoning behind trading options and doing covered calls is that you want your money to work for you. The day and age of when your grandpa used to buy AT&T and then just sit on it for the rest of his life and retire with AT&T stock, it's just not there anymore. If you do that, you take a big chance of the market actually falling out from underneath you, and all of a sudden AT&T, which was $62, is now $15. Mm-hmm. I make that example because it happened to my brother back in the 1990s. His whole 401k was based on AT&T stock. And I do know some people that had their whole retirement set on Braniff Airlines. And we know what happened with Braniff back in. The main reason that we're actually doing this is to teach people how to trade options. So let's go ahead and start with the very basics. What is a call and what is a put? So Pat and I have been walking around. We've been doing a lot of talking about, what is a call or what is a put? Call is you're buying the right but not the obligation to purchase that stock at a future date, which is called the strike date, and you agree to pay a premium to do that. Now, if you sell it, like Pat was just talking about, you're selling a call. You own the stock, and you're selling it for the it's $110 right now, and you're selling it to somebody with the opportunity for them to buy it at $115. That's selling the opportunity, but not necessarily the obligation to buy it.
So it can go both ways.
And it can go both ways.
You can buy one, and you can sell one.
Right.
Okay.
So selling it is what we like to do a lot of. But sometimes when we're selling stuff, we have to actually buy the stock on the other end to cover it. And that's where we get into the options, and we may buy a 45-day share and use that, take control of that stock for the next 45 days and write calls against it. So understanding calls is fairly simple. It's like renting out your condo. It's the way we've always talked.
Right.
When we talk about our examples, you wouldn't necessarily go and sell your $100,000 condo just because it went down $10,000 over the last 6 months. No, you'd keep renting it out.
Right. Exactly.
Right. And hopefully by the time you went to go sell it 5 years from now, it would be much higher than $100,000. But just like real estate, stocks go up and they go down. And the calls are where you're renting out your stock to somebody else who wants to get it for a good price, kind of like a lease to own. You know, hey, this thing gets up to $110,000 and I can buy it at $100 type of thing. That's kind of what you're doing, is you're capping out your profitability but earning a premium in the meantime. Now, a covered call, as we said, you're buying or you're selling the right to buy the stock at a higher price in the future date that you pick. So you pick the price and you pick the future date, and then you bid back and forth with the buyer of this opportunity that you're giving someone, and you agree on a premium. Because you're not going to put it out there and say you can buy my stock at 115 even if it goes to 120 without getting some kind of premium, giving you something, in return for the risk that you're taking, because you own the stock and it could go down. They want to buy it at a much higher price but not pay more than 115 for it. How much will they give you for a premium? Well, you work that out between the two of you. So I will just do a quick I'm going to show you just a quick example of how these actually work in real life, and this is the way that our program will go in the future. And I think it'll give everybody a good idea of what we actually are going to be looking at, because I don't want to end up talking. Yeah, I see it. I don't want to end up talking just about the theory of everything, especially in this first half hour that we're going to do here for this live stream. So give me one moment, and I will actually share the Tastyworks platform, and it might give you a little bit better idea, and we can talk about what a call is, and you'll be able to see it live on the channel. So.
And when you're doing this, I'm going to ask you a couple of real-world questions, because
right.
I've known Rich for a long time. He deals in numbers like an artist deals in watercolor or oil, and it's very second nature to him. Average person, it isn't, but it's not something that they can't learn. And
somehow we got to make this exciting, but it's
we are. I've never been accused of that, but yeah. But I mean, but the thing is when you go in here, as he explains it, I'm going to be asking him some questions, because there's going to be some things that are just absolutely intuitive to him that probably aren't to, definitely me and maybe other folks.
Right.
And that is my purpose here. I'm the experiment. So.
All right. So here's a good example of what the screen actually looks like when you're in Tastyworks. Sometimes when I stop and go back in, it'll freeze up because they want to take a picture of the actual screen. Here's the screen, and I'm showing the Twitter.
That's your stock.
That's our stock. And when we're talking about a call, that's the C. All right. So we actually own 4 options, which is like owning 4 sets of contracts on Twitter. And that 4 represents 400 shares of stock.
And those are 400 shares of stock on an option that you paid for, correct?
Right. And I paid $832 for this option. And I have the right, but not the obligation, to buy this stock at $75 on August 20th.
Okay.
Okay. So That is where you purchase the stock. I was the buyer. I bought this stock, right, and it's not at 75 yet. It's only, the last week in July, so I've got a few weeks. Well, I bought it when it was under that. I bought it right about $70. So I'm only behind $100 on the actual stock, but I have control of those 400 shares of stock. Remember, it's 4 times 100 shares. So how do you make money on owning the shares? Well, you rent them out. And that's where this -4 comes from. So what I've done is I put a call on here. I bought this call as 75, and I put a call of 75 on August 6th. So if this does not get to 75, this rent to own idea, this is option trading, and this is the very basics of options. It's not difficult. It's not rocket science, but there's a heck of a lot more to it than just placing the trade. And that's what this channel will be about. We'll be talking about extrinsic value. We'll be talking about trends, what a stock does when it goes up or down, what its 60-day, what its management's about, what it's been looking, for the last 2 years, what has its price history been, where's its P&E, all that kind of good stuff. So you kind of get a really good feel for your stock. What we've got here is the Twitter, and we've got 4 calls where we have offered to somebody, and we don't know who that is. The broker is the one that arranges the transaction. You don't actually know who you're selling it to, but you're not selling it to a bank or a hedge fund, or you're selling it to somebody across the table. So every dollar you make takes away from somebody else's account. So there is no secret pool out there of money that can be gained. But our advantage is there's a lot of day traders out there trying to buy this stuff real quick and get out of it real quick. And 75% of all day traders, if you look at any of the YouTube statistics that are out there, anything on Google Finance, 75% of the people lose money. We try to make money 80% of the time. So
what you're doing is you are basically the opposite side of the people who are trying to make a lot of money really quick, but most of the time lose.
Think about it as being the banker.
You're going to be on the other side to where you're going to make a little bit of money, but you're going to do it consistently, repeatedly,
with a lot less risk.
With a lot less risk.
Right. So what's my risk here? Well, the risk is that it goes over 75. Well, if it goes over 75, I already bought it at 75. So if it goes over, then I will actually start owing this person some money. Okay. So the idea is I'd like to stay under 75. So right now they've paid me $676 to do this transaction. Now, if I wanted to get out of it right now and eliminate the obligation and just say I want to take my money and go home, I'd have to pay $430 to get out of this obligation of selling this stock for 75 on August 6th.
Okay. And unfortunately, I cannot see the comments if somebody's asking a question. Does it make sense to walk through, like what we were talking about earlier, what each one of those columns mean? Or
I think so. We weren't getting many comments, so we can just stay here on the big screen and show it here on the big screen. So let's walk through each one.
So let's start. So before you did anything, you went out and you bought 4 contracts, which is 400 shares at for $75 for $75 on August 20th. Now, if I look over to there's the trade price line. That is what you paid for it at the time. Is that correct? $832.
Right.
So to get that contract trade price, that's what you spent. You spent $832 real dollars to get that.
Right. Now, how much do you think it's worth right now if I wanted to get out of it and sell it?
You'd sell it for $732.
Right.
So
because it hasn't gotten to 75 yet.
So as of this instant, if you decided I want out, it would cost you $100 to get out of that. So you'd have a $100 loss.
Right. But I'm already into this for a week, and I'm getting closer to 75. They gave me $676. That went into my check account.
That's really important. So they gave you $667.
That's my premium.
In order for the call for $75 on August 6th. Okay.
Right. So if I wanted to get out of this right now, I could actually just get out of it for $246. So I'd be behind $100 on the option, the stock option, and I'm ahead $246 on the premium.
So actually you'd be out for $430, correct? And it would be a $246 profit. Is that correct? Am I looking at that right?
It'd be a $146 profit. Yeah, I could get out of it for $430.
Right.
You're just talking about the call.
That one line.
Yeah, this one line.
So your net would be 140. So you could call it a day right now.
And be 146 ahead. And how much did I invest in the first place? The 832. Because that is my trade price. Okay. So the trade price means purchase price. Mark means how much it's worth right now. So at this moment, it's only worth 732, and I paid 832 for it. It happens to come out to a nice even number, 100. Yeah, real pretty. But I sold a covered call on this, and I sold the call against it. They gave me 676 as the premium, and it's getting closer to August 6th. We're only a little over a week out, and they're saying, well, you could get out of it for a lot less than we gave you. So you can get out of it 430 and make 246. So you take the 246 and subtract the 100, and it comes up to 146 profit. The thing that we really concentrate on is return on investment. So if we could make $146 on an $832 investment, yeah, you're looking at about, what, 1/5? That's 20%. We've only had this for a week. So if you could make 20% every week, rinse, repeat, we'd do that all year long. Yeah, we would do that all year long.
Okay, so
I'm going to hold this because I only have, right here, 12 days left to go. I only have 12 days left to go. I think I'll hold it and see if it gets to 75 so that I can go ahead and earn the rest of this $430. Now, they gave me this 676 up front. So it's always giving them back some money. If you give them back some money, it comes out of your checking account and you give it back to them. If I hold it till next Friday at 3 o'clock and it stays below $75, this time value here, the 430, they call it extrinsic value, what I have to pay to get out of my obligation, he's kind of got me right now. I have obligated to sell this thing for 75 up to and including August 6th. If I'm going to get out of it, it's going to cost me $430. But I'm not at the 75 right now, so why would it cost you anything, right? You're not there. Well, it's because you got more days. You got time left in it.
He could still win.
He could still win. He could still get above 75 and turn a profit.
If it all of a sudden shoots up to 78.
But it's not looking too good for him right now, or her on the other side. He or her on the other side has got an 81% chance of not making a profit on this thing.
So I'll ask you a quick question. The 81%, in layman's terms, in Pat Herbert terms, how do they come up with that number?
They do algorithms, and they do all the different, how this stock has done over the years. What I like to look at, instead of the POP here, this is just part of their program. These columns here I have set into my portfolio so I can actually look at things properly. What I really like to look at is I'll go up here and do a trade, and that one's on Winnebago. Let's put it on Twitter.
And the goal is to buy one, not end up living in one. Anyway.
Okay.
I thought that was
what?
funny.
Is that funny? All right.
No,
all right.
You want to make enough money to be able to buy one,
so,
be forced to live in one.
Okay. On Twitter, let's go to August 6th. Go to August 6th. What is the chances that this will get out of the money? So I did an out of the money here. What does out of the money mean?
Thank you. And you know what? You explained it to me. I repeated it to you, and I already forgot.
That's all right. Out of the money means what are the chances that this stock price will not get to 75? The chances are 74% that it won't get to 75.
And in this case, out of the money is a good thing for us, correct?
Because we sold a call.
When it's in the money,
means
that the buyer is going to be able to transact this.
Right. So let's say we bought 4 of these. We have a 26% chance of getting to 75. Notice 26 from the out of the money
Is 84.
is 80.
No, it's not
74.
84. See, again, I went to public school.
There you go, public school. 74 out of the money, 26 in the money, but we're selling a chance for you to buy this. Now, if I were to buy this today, sell this today as the banker, I own the stock. I own control of those 400 shares, the 4 that's over on the previous screen. How much can I make? Well, over here, the average between this is the ask and this is the bid right here is 108, 1.08. So if I put it up to 1.08 and I said, okay, starting today, July 25th, we got 12 days to go. I'll sell you the right, but not the obligation to buy it for 75. Now you're going to hope it goes to 80 because you want to buy it for 75 because you're going to pay $1 on it. Okay, you're going to pay $1.08. Now remember that's $1.08 times 100. They always do it that way. So if I look at my review and send, I can actually make $432 for the same deal that I did last week and got $676. Now notice that 432 is about the amount that they said I could get out of it.
Right.
So everything is really priced fairly. You're really not going to be able to play off one over the other because it's gonna be pretty darn fair. So you can't go back in there and become the buyer and make a ton of money off somebody because all this pricing is fairly fair. So anyway, that's when I go back and I look at the orders, I'll look at this and say, okay, you know what? 75 is a little too close for my comfort zone. I'd rather take a little less risk.
So I'm going to back you up, but just to make sure that I understand this. The previous screen we were looking at is basically a synopsis of where you're at this moment.
Right.
This screen right here is an actual execution screen.
This is how to trade.
Where you can actually go out and trade.
Yeah, this is how we got to the -4.
Okay.
Yeah. So to answer your question, yes. We did that previous screen to get to here. We did this last week. We got $676. We've got a contract with someone. He or she can execute this at any time and buy this for 75. Are they going to do that? Probably not when it's $71. I've never had anybody do it yet. But when it gets close to 75 and maybe within a few cents, they might. And they can do it at any time. So the trade screen, the reason why I thought it was handy to look at the trade screen is we're talking about risk. And this is what the whole channel is going to be about when we talk about this in the future. It's not so hard to pick the stocks. Stocks are a 50-50 proposition. You're going to go out and do your due diligence. You're going to try to pick companies that you feel good about, companies you may know, people you might have worked for. You're going to pick a stock. You're going to feel really good about it because you wouldn't have bought it if you didn't feel really good about it. And then you're going to get surprised, and the stock's going to go down in price the next week. How do you make up for that partially? Well, you do options, and you do some calls on the stock that you own, and you let that stock work for you. When it gets back up to where you want to sell it at, whether it's at a loss or at an even or even above the money, they call that in the money, then you can sell it when you want to. But in the meantime, make some money as you're going up. Now the risk, I moved that down to 77 from 75. Look how much money I would make now. But there's an 84% chance that it stays out of the money. So wouldn't it make sense that if it's at 71, that it might be a little harder to get to 77 than it would to 75? That's where out of the money
so what you're saying is, and this is the buy-in option, correct? Or no, sell-in option. So what you're saying is if you put that price at 75, they're going to probably pay you what? The bid is what, $1 for it, right? Yeah. So the mid is $1. The midpoint between this is the bid and this is the ask. Most people are asking 111. They're off they're bidding for 104. So you'll settle somewhere.
most of the time it is somewhere in the middle. It's not one number or the other.
And I'm going to go back to that in a minute because that's can be a little bit, unclear in my eyes. But the way this software is setting up, it's saying it's a 74% chance that you will not.
No, you will not hit 75
and have to sell the stock.
Right.
Okay. Now,
give that person your stock for 75.
So in some cases, depending on how conservative you may want to be, you go to the 77 and say, hey, it's a 77. Yeah, I'm getting less money, but
it's a much higher percentage of not hitting.
Which,
and I'll do this, Pat. I'll go down and I'll look for the 90s, and I'll pick a 92% out of the money. And yeah, it's 80. I mean, but think about it. How many stocks jump $9 in 12 days? Not too many.
No.
What's amazing is someone's going to pay you $33 for that opportunity to buy it at 80, and if it never gets to 80, they lose the $33.
Right. And in this case, 92 out of 100 times, that's exactly what's going to happen.
Right. So Tastyworks, the online broker that I use, gives you these numbers, and there's a lot of other things involved here that they give you, like the delta, the theta. We'll go through all these, the extrinsic value, the implied volatility. Yes, there's a lot to this, but the basics are, for options, it's all about calls and puts. And whether you're doing an iron condor, or you're doing a butterfly, or you're doing a covered call, or you're doing a synthetic stock where you're picking something out on August 20th and selling calls on it for a month, that's a synthetic stock, sometimes called a leap, which is a long expiration anticipated product. Usually they're a year or two out. These 45 days are not really considered leaps. They're just synthetic ways to buy stock for less money.
So a synthetic stock, you don't actually own the stock, correct?
Correct.
So you're basically buying the option
right
to
here.
Buy it.
This is a synthetic buy.
Okay.
We have bought these 400 shares that we have bought the right to buy it at 75, and we only paid $832 for 400 shares. So we just own a small percentage of it. But the really nice thing about trading options is now you have control of this.
And so if you actually own the stock, instead of $832 to be able to do an option on it, you would be at 400 times 71.69,
right?
Or whatever you originally paid. Okay.
Yeah. So you can go up or down a lot with a synthetic stock. This could go up $200 or $300 up and down. But if you get a good premium because the volatility is high, we're getting a lot farther into this than this is about 6 months down the line when we understand all these different things. I think today we just wanted to look at the big picture, see how you make money, and then we can start talking each week about, well, what is volatility and what's extrinsic value and how should I be picking the stock in the first place?
That's my
yeah.
thing.
And I would say this is what I tell everybody that I work with. This is like your store. You throw a couple $100,000 into your store, you bought the inventory. Now you go out and you rent it out. It's like a rental store. You're renting it out. And your value of your store may go up and may go down. But in the meantime, you're renting it out until you decide to sell the store. And you can sell the store in portions, one stock at a time. And you don't have to pay a real estate agent, the 7% or 6% for the real estate fees. You don't have real estate taxes. You don't have maintenance on it. But what you do have is, for every option of 100 shares that you make a deal with somebody else, your online broker will collect $1. And the Securities and Exchange Commission, the SEC, they'll collect their percentage, which is about 12, 13%. So, if you've made a deal, the online broker is going to get $1, and that's not $1 times 100. That's just $1.
That's a buck.
That's a buck. Now, some of you guys that might have been around for a long time, like myself, remember doing E-Trade deals at $4.95 and thinking we were having a steal. Nowadays, you can do the options for $1, and when you buy full sets of shares of stock, started last year, they don't charge you anything at all. You can buy full shares for nothing from the online broker, and you just pay the SEC fee, which is fantastic. It's the day and age of being able to trade like a retail investor should be able to do without having to compete with the banks and hedge funds that can go directly to the stock market and buy these stocks. We have to go through a broker. And, I've paid $19.95 to Fidelity and Vanguard and others in the past to make trades for me. And I've paid $4.95 to E-Trade. That was back during the 80s. And I was doing calls in the 80s and paying that kind of money. My commissions had to be a big factor in this. So now the commissions are not nearly as much of a factor. It's making it a lot more profitable. And I really don't even worry about the commissions except for when the stocks are really cheap. Let's say you do a Ford stock at $13, or you do a Aurora Cannabis stock at $9. Well, that's 9 times 100, which is $900. And if you start doing options and you're doing 10 or 20 options at a time to get a premium build up, well, you're paying $10 or $20 to make that transaction. Where if I'm doing an Alibaba, I can actually be trading a $200 stock, which 200 times 100 is $20,000. I'm making a $20,000 trade for $1. Okay. Doing the setups and making the trades is not hard. What's hard is picking the stock and then deciding how far do you want your strike to go out? 2 weeks, 4 weeks, 6 weeks?
It's a strategy.
Yeah, it's a strategy. And then you got to kind of know the ebb and flow of that stock. So if it goes down, you can't be that concerned where you just want to jump ship. That's what retail investors are known for, and we don't want to do that. We don't want to jump out of it because we've got obligations and commitments. And when it goes way high, if it's too high for your blood, and you're thinking, no, that's just really unusual that it jumped this high, then it might be a good time to sell. One part of the channel is teaching you how to go online with the online broker and look and see what your calls are, and how to set that call up by using the trade button. You set up, but you got to know what you're doing first before you go and trade. So you got to actually do the setup, and we'll talk about the setup. Yeah. How are you going to pick the stock that you want to work with? Are you going to work with Peloton or Winnebago or Twitter or Alibaba or Blink or Yellow Truck Lines, Neo, Xpeng, Alibaba, blah blah? And once you decide which stock you're working with, I'm not running a channel to go and pick stocks. I know how to pick stocks and I take my best shot at it, but I'll answer questions and we can all talk about it. And I think we can all, discuss certain stocks and which ones we should be in or not be in. And you'll find that we jump in and we jump out of some, but the majority of them we keep for 3 to 5 years. So the channel is about teaching you how to execute the option trades to make money. And stock. So I've got Kronos, I've got Golden Nugget Online, JD.com, Nordstrom's here, Kroger, McDonald's, Mary Jane, which is the marijuana, EFT, and Marvel. And I actually keep track of how much I've made in premiums. Now look at this one, MJ. Cost after premiums, current liquidity, my gain or loss from the stock. I don't own any stock on MJ. So I've done options on it, and so far this year, since January 1st through July, I've made $1,400. Now with Marvel, I actually do own some stock. And when you look at how much, total stock I own, it's not full shares. So I've got 700 shares at $28, so you're looking at about $14,000. And this is one of my better ones. Even though the stock really cost $56, I didn't pay $56 for it. I'm paying about $28 for it because I bought an option on it. But I have control of that stock. Those 700 shares I have right here, I have control of that. So I'm out there selling calls on it. Now, I'm also doing puts, and we won't get into that right now, but we do puts, which is the opposite of calls. And how much did I make so far this year? 11,709 on about a $14,000 investment. Now I'm only paying, if I own the stock completely, it'd be worth 39,000. But I own it at 28.63, and the stock is worth 56 right now. So I just happened to grab this. It just happens to be exactly half, doesn't it?
And this 28.63 represents
my option price.
Your option price.
Yeah. So when I look at, what I bought it for, I bought it for 16.60. It's worth 28 right now. What's my expiration price that I could buy it for when it does get to the end of the option? $30. It's a $56 stock right now. But at the end of my option time for this particular one, I can get it for 30. So, when I look at, there's actually two sets of them. I bought 300 at one point and 400 at another point. So I bought them at different prices. I bought that one at 16.60 and that one for 24. I can actually make some pretty good money on this thing. So far, just doing the premiums year to date, I've made 11,709. Now I'll let you in on a secret. This particular account started with $100,000 at the beginning of the year. Okay. So when I start adding up all, and I could have some negatives in here. There's one. Romeo. Yeah, Romeo. You're going to lose some of the time. I lost $2,600, but I made $36,000 on XPing, and Zynga I made $822, and we're only halfway through the year. So how much is it up so far? Well, when you look at this, the premiums are up $89,000. And my liquidity, which is how much money I pulled out to live on, I'm retired, but how much I pulled out and how much I actually have invested, I have $152,000 invested in the inventory. It's currently liquid with $128,000, but we've pulled $23,750 out of it. So the premiums have actually really kicked in pretty good. Live stream. There's a lot of info out here, but let's break it down into small chunks and learn about calls first and then puts, and then let's learn about extrinsic value, and let's learn about risk management, and then how to keep track of your return on investment on a spreadsheet, and how to pick the right stocks. There's just a lot of topics that we can cover, and we'll do it slowly enough so that everybody can kind of get the hang of it. And in the meantime, I'll be going to the Philippines this Friday. I'll be in quarantine for the next, follow about 80 stocks, and I really buy and sell about 20 of them. There are lots of stocks out there. Are we going to talk an awful lot about picking which stock over the other stock? No, not really, because I really don't care which stock you've decided to purchase. As long as we can do premiums on it through our online broker, that's where we're going to make the money. Now, if you picked a great stock and it just zoomed up, great for you. But what I usually do, is it is 50-50 for me, I always seem to have a brown thumb. I'll pick the stock and it goes down immediately. Do I get bummed out? No, I just let the thing come back. Once it comes back and gets above the original price, now I can consider selling it. But in the meantime, I keep writing premiums on it and making money off that stock that I own. And then when it gets above and gets into the green on the actual stock, then I kind of just play it by ear on, do I think that's too high for that stock and it may come down in the near future? I don't care if it comes down a little bit in the near future, but I don't want it to crash. And if I feel like it went up because of some FOMO deal, fear of missing out, and everybody and their brother saw it on CNN and started buying it, well, that might be something I get out of once I believe it's topped as far as it can go. But in general, I own the Facebooks and the Microsofts, the McDonald's, the Taco Bell, which is Yum, the Pepsi. In the Chinese stocks, I'll do Alibaba and JD.com and XPeng and NEO. That's about it. Those four. On the American side, I pick the S&P 500 and try to stay with the stocks that I know something about. One of my steadiest stock that I have is Kroger. And, I worked for Kroger for 8 years when I first got out of college. And it's always just steady as a rock right there in the mid-30s. and I play it when it goes down to 33. I put puts on it. When it goes up, I start doing calls, and it gets at 39. I know it's not going to stay at 39.
Stayed in that band,
yeah,
band
just stay.
Decades.
I'm fine if it stays right where it's at. The Alibaba I have owned for 3.5 years. 3 years ago, it was 210, almost to the day. It's 206 today.
Wow.
Yeah. Now it was 325 about 4 months ago. It fell for a lot of different reasons that we can go over on the channel, and we'll talk about it. But these are part of the things you do your research on. Why are the Chinese stocks falling so much? Well, there's really good reasons for that, and some of them are not so good of reasons. And we'll talk about that on the channel.
Point, if it was a buy and hold strategy and you bought it for 210 and it's at 206,
you didn't make much.
It's a loser.
Yeah, it's a loser.
Because you can do the premiums, you can kind of control your destiny, and now it's really a winner because you're making money off of it.
Right. And if I showed you what I was making on Alibaba over here, the premiums are great because I'm making about $200 every 2 weeks on Alibaba premiums. So even though it's an expensive stock, it's over $200. You got to buy 100 of them if you buy that stock outright. But I don't buy them outright. I buy an option on them. So I buy a leap, and I have several leaps, and I just keep working them. And when they get back up to 230, 250, I may sell off a few leaps and go into something else. But over the last 3 years, I've kept Alibaba this whole time because I make such good premiums on it. So as long as it stays about what I paid for it, then I'm happy. Right now, I'm not happy because I'm really down on the stock. I purchased it for a lot more than it was worth. Not more than what it was worth. That's what it was worth at the time. What you buy it for is what it's worth. But it went down, so I have to wait for it to come back up. In the meantime, I am doing premiums on it. And if you look at what I've made in premiums, I've made up all the inventory loss. If I wanted to go ahead and sell it right now, I would have to pay IRS taxes on it, even though I'm down like $50,000 because I've made more than $50,000 on the premiums. So we'll talk about taxes and how that works.
Your goal is to have to pay a lot more taxes.
My goal is to pay a lot of taxes. Yeah, that is the goal. So anyway, thank you for tuning in to Trading with Rich. You can contact me at tradingwithrich@yahoo.com. I will be in a hotel in Cebu, and no, you can't come visit me because I can't even leave the room. My wife and I have to hang out for 10 days together. So if we're still married after that.
She's an incredible woman.
Yeah, she is incredible. But if she can put up with me for 10 days, especially with me being on the computer doing these stocks every day, if we're still married, I'll have some money to talk about. But if we're not married, she'll take all my money and I'll be broke. So that won't happen. Anyway, thank you for coming to watch this first live stream. I'm going to go ahead and sign off now. Everybody have a great rest of the weekend that we have here on Sunday night, and have a profitable week.
You're so bad.